Okay, so welcome to the June session, and you are coming live from the new studio, which is a bit of fun. So we've got everything that is now working within the studio, and I'm just interested. Well, you should be sharing you should be able to see the screen here in terms of the process. So just confirm everyone, you can see you're basically seeing June Mastermind. Is that correct? Just type
Yeah,
it.
we're seeing
Yeah.
that.
Okay, cool. This thing, I'll take a picture for you. It's like flying an airplane. It's so flippin' complicated. I don't know which screen you're looking at. Anyway, in terms of that process, if you look here, where are we going? Okay. So let's rock and roll. Reminding everyone that we're here for globally diversified passive income and portfolio growth. How do we do that? Well, we diversify across countries, currencies, assets, partners, and time. And then we break down the goals into long-term planning, midterm, which is our monthly planning, and then our tasks and our activities. This is the overall framework that we use with the family office. And what we're focusing on now is the community partner and the knowledge transfer and the investments and the results. I remind you as well that there's always 2 sessions on the middle Wednesday of every month. Step 7, which is the accountability and the checking in. And there's 3 sessions. You've got the early morning session, which you've just done. There's the hour after this session, and there's this evening. So hopefully, no matter what time zone you're in, you should be able to access it. And then also you've got step 8 and step 9, which is where we do the Calio market review, the Calio private equity update around deals, the one main theme for the week, and then admin for the month in terms of the process. And why do we do it over and over again? Well, repetition is the mother of skill. It's all about repeating over and over again in terms of the process. So what do we try and do every month? It's countries, currencies, assets, partners, time and time management, mindset and strategic thinking, execution, accountability, and investing and review. So we're changing things up a little bit this morning. So Anthony he's got an important meeting this morning. So he's going to join us at 10 o'clock. And the whole session will be recorded. So I know, Angie, you've got a call at 10, but I will record it so that you don't miss anything. So what we're going to actually do is we're going to get started with the session on the 100-year life. And this is all about rethinking wealth, risk, and returns in the age of longevity. So I know, Alex, this is something that you are very passionate about. So before I get started and go into the process, do you want to just talk to this, Alex? I know you're here. Why are you so passionate about this 100-year life?
Thanks, Scott. I've not done my homework, but very passionate about this. So I'm just gonna, shoot from the hip. Look, I this kind of concept we learned it. What is it now? 3, 4, 5 years ago, and since then I've been obsessed with the way that it's kind of been weaved into our day-to-day lives. Anything from tech to the new economy of how we actually make money from that perspective, and also how the different patterns and the different uh, rhythms of life work. It's not that aged old classic, you go to school, you learn, you get a degree, you go work for 40, 50, 60 years, you retire, and then you just live off that. It's a whole different concept. And I mean, I've read the book about twice now from Klaus Schwab's, and the whole 100-year life is a fascinating topic. So I'm quite interested to see what you've come up with here today.
Awesome. Okay, so we're going to pivot straight into this. Before we go into it, just a couple of things that I wanted to let you know about. So when I presented with Robert Kiyosaki about a month ago, this was actually a picture, funny enough, it literally got caught on camera, where he called me over. I was telling him about my book, and he called me over and he said, if you help people invest internationally, you need to get on this boat trip to come to the Investor Summit. So I actually leave tomorrow for America. And if you are interested as part of the mastermind, there are some incredible speakers, from Robert Kiyosaki, Peter Schiff, George Gammon, Mike Maloney, Ken McElroy. There's about 14 speakers, and there's
Sorry,
40.
Scott, just a quick one. I'm not sure if it's my mistake, but I can't see you sharing.
Yeah, yeah.
They're now sharing. Yeah.
Thanks for letting me know, Alex. So this is the Investor Summit. I leave tomorrow, and you can see Robert Kiyosaki, Peter Schiff, George Gammon, Mike Maloney, Ken McElroy. There's a whole bunch of men and women. There's 40 different investor presentations. There's about 200 investors coming. There's behind the scenes billion-dollar wealth strategies, real conversations. And so what I'm going to be doing is basically trying to take all the information and to synthesize it at the summit. And as part of the mastermind, I'll be posting it for you to be able to get the insights. And we're also tying it in with the relaunch of Wealth Going Global. So every 2 years, I do Wealth Going Global live with the latest updates from what's happening around the world. And the timing couldn't be better to go and get literally the best information out there in terms of the process. So if you want to go and check this all out, the landing page is wealthgoingglobal.com. You can go and see who all the different speakers are. If you've got any specific questions that you would like me to ask, literally, I'm going to put a post into the school group, and you can just go and write them up and let me know. But it's everything from property to macroeconomics to cryptocurrency to commodities to the stock market, to oil and gas. You can literally see monetary policy. There's literally everything in terms of understanding what is going on. So I'm really, really excited about this. And for you mastermind members, you can literally go and get the insights, etc. My question to you all is that for next month mastermind session, my thinking was to bring back and within sort of 90 minutes distill the main themes. Would you like that? Yes or no? If you could put that in the chat box, because I will try and, I will be keeping you updated on a daily basis. I'm also going to try and synthesize all the presentations. If any of you watch how I do it nowadays, I can take an entire presentation like I did with Robert Kiyosaki, and I can synthesize it using an AI. So I don't know if I'll be able to attend all 40 presentations, but I'll do as much as possible. But I can see lots of people. Okay, so that'll be next month's session. So for the mastermind members, you'll be able to get access to that. Then just in terms of Wealth Going Global, the relaunch of that is the 22nd of July. So it's 6 modules, 6 weeks. I know many of you have done this. In fact, some of the top mastermind members actually came through this course. But effectively what we do in week 1, which is the 22nd of July, we're going to do it Tuesday lunchtime. So Tuesday lunchtime, my lunchtime, so 12 o'clock South African time, 11 o'clock UK time. That allows the Australians to participate and it allows the Americans to participate. And the first module is the power of clarity. The second module is the countries. How do you choose the right countries, the top 5 countries? The third module is the currencies. So that'll be with James Painter around how do you choose the right currencies. Then it's assets, the top 15 assets. Then it's partners. How do you choose the right partners? Then it's time and building a wealth plan. And then finally is a bonus module on smart investing. So if you've done it before, you don't need to do it again, just to be clear. But if you want to do it live with me, then I'm running it live from the 22nd of July. And then just to let you know, I asked you a couple of months ago and I said, which sessions would you like of all the key frameworks that I think as an investor are fundamentally critical for you to know while you are going on this investment journey. So we started in March with the 16 mega trends. We then went in April to exponential technology. We then went in May to Society 5.0 and the 40 Wealth Framework. And then we bring it all together today with the 100-year life. And if you want to understand why I did it in that order, it's really important to understand what the macro trends are around the world. So there's 8 technology trends, there's 8 societal trends, and it's creating a generational shift, which is all happening as we speak. So we need to understand the long-term big picture. And if you remember, I spoke to you about Ray Kurzweil and the importance of knowing long-term trends and where they intersect. Then we needed to go into the, what is exponential technology and what are exponential organizations? So we went into that detail in terms of that process. Then we went into Society 5.0. So what is Society 5.0? How does exponential technology enable that? What is an exponential organization and how does it enable Society 5.0? And who do we show up as in investors when it comes to Society 5.0? And then finally, the 40 Wealth Framework. How do we take all of this information and synthesize it and actually help us with regards to our investing? And we will now pivot into the 100-year life in terms of that process. I did want to remind you, I did mention it last month, but just as a huge announcement we made last month, which is very exciting. that Calio is actually joining us as a shareholder, which is really a massive step in the right direction for us in terms of the institutional investment. I actually was at their annual dinner last Thursday with the entire team. They've got quite a big team, actually. I was quite surprised. And it was really, really nice now as a shareholder to be invited to that function, which was fantastic in terms of that process. Then for those of you, I know a number of you have had the chat with Alex between the 6K and the 12K club. There's a significant value uplift that we've put together now within the 12K club. I'm working hard with Garth and Anthony from their side of the fence. I've had meetings with Bianca and Karen. They're actually updating and renaming the Enneagram and Wealth to Enneagram EQ. I know that Amy's doing and getting started with a number of people on the Family 360 and how do you set up your family for generational wealth. And then from my side, you've got the transformational one-to-one coaching. So if you are interested, chat to Alex. We've really tried to enhance the process in terms of the value add. And then lastly, we've got the next Wealth Weekend. We were originally thinking of doing it in Portugal. We have put together a partnership, and we're in the process of putting together a partnership with Paul O'Mahony at Calio and ourselves. That is still being finalized. And so we've decided to do the Wealth Weekend in Neisner in September. So the 10th to the 14th of September will be in Neisner. Once that business partnership is finalized with Paul O'Mahony and Calio, then we're going to do Portugal, because obviously Paul's got significant reach within Europe and England, etc. And we want to do it properly, and I don't want to rush it. So in terms of the dates, I would strongly recommend, if you haven't been to a Wealth Weekend, there's nothing more valuable than actually coming along and being part of a Wealth Weekend in terms of that process. So I'm going to put up a little poll, and I would just ask you to go and fill in the poll. It's just feedback for us, which is always useful. And I will leave the poll open while I get going on the 100-year life. But you can see there, the poll should be up on your screen. Can I just confirm you should all have it? You just give me a thumbs up. Scott's frozen. Keep losing sound, Scott. You got me? Angie, I can see you. You can see me. Hello.
Yeah, I can now, Scott.
It seems fine now, Scott.
Yeah.
Okay, cool. Okay, so the poll should be up. Can you just confirm, Shanika, and if you can see the poll?
Yes.
Okay, cool. So if everyone can just do me a favor and fill in the poll while we go through it. Okay, so I hope you're ready to strap yourself in, because this is probably one of the more interesting presentations that we've put together. I know, Alex, you were talking about it, and we first got introduced to this. I don't remember the year, actually. It was 2021 or 2022. And we actually invested a lot of money. So we paid an external marketing company to go and do quite a lot of external research. They took 3 months to do a project. And in that project, we were basically saying, what is the future of investing? Because about in 2015, we did a similar exercise, and I've shown you this, and I showed it to you in the 16 trends, where we went into how there was the evolution from email to e-commerce, to social media, to finally social commerce, and the intersection between those two. And so around 2021, we decided to orchestrate the same thing and say, right, it's been 5 or 6 years later, where is the world going, and what impact is happening around the world with regards to investing? And specifically, what should we be doing as investors to take advantage of that? And then also for our business, what should we be doing, and where should we be positioning ourselves? So as a mastermind member, you're gonna get a little bit of a look in behind the scenes here in terms of that process. Oh, what's going on here? Oh, I know what's going on. I got to swap the presentation over. Having a bit of a brain freeze there. Okay, so let's rock and roll in terms of that process. So my first question, let's get you in the room. What if you live to 100? Would your wealth plan change? So if you think about it now, and when you put a plan together, just ask yourself the question. And if you want to type in the chat box and engage, I'd appreciate it. But what if you lived to 100? Would your wealth plan change? My gran lived to 97, and my father only lived to 59. So I'm not sure which side of the fence I'm going to get it from, my mum's side or my dad's side. If I take it average, that's about 80. But again, if you're going to live to 100, would your plan change? And I think this becomes a very big reality for all of us in terms of our investment decisions and how do we actually do this. So what we're going to cover in this session, there's 4 different parts to it. The first one is part 1, the age of longevity. So this is where we're going to go into some deep analysis around what's happening in the market. And I'm just warning you, it is quite stat heavy, and I will share these slides with you. I'll share them with the Mastermind members on the agreement that we don't share this externally. This is our internal IP. Is that fair? Yeah. So just an agreement. I'll give it to the Mastermind members as a gift, but I don't want it going externally. Part 2 is investing for the 100 years. Like, what do you actually do if you're going to invest for 100 years? Part 3 is the psychology and planning of the 100-year investor. And part 4 is the practical application and the action steps. So I don't know how far we'll get. My aim is to get through the age of longevity before Anthony, and then we'll go through Anthony's session, and then I'll come back and do the other 3 parts once Anthony's done. Okay, so let's get right into it. Part 1, the age of longevity. So the first problem, and I love this, Alex, I don't know if you can remember this slide, but I love this slide because some people talk about the proverbial hamster wheel or tread wheel, but the first problem is that we're all doing the same thing. We're all going to school, we're all going to university, we're trying to get a great job, we're investing, we're trusting the financial industry, we're paying our taxes, we're getting to 65, and we're hoping that we're going to retire and live a happy retirement. And unfortunately, statistically, as you've all heard, it doesn't work. But as these little pandas are doing, round and round and round, doing the same thing, generation after generation, and nothing changes. There's another way of looking at this, which is a little bit more stark. And in reality, a lot of us have heard of the hamster wheel. But actually, this picture comes from 1817, where in prisons in England, they literally made you stand on a machine walking and doing cotton and stuff. And I quite like this because if you look, you've kind of got the workers working and you've got the wealthy people kind of over here chilling. And it's quite a good depiction of the proverbial hamster wheel that most people find themselves on. So that's the first problem. The second problem is a lack of education when it comes to investing online and or in alternative assets. The results, people are fear-driven when it comes to investing and reacting from self-preservation and scarcity instead of a place of knowledge, confidence, growth, and protection. The 100-year life. Every society is increasingly likely to grow old, living to 100 while becoming a norm. Financing longer lives is a complex challenge for governments, corporations, and individuals needing to tackle it now. Financing the 100-year life is not only a consideration, individuals should live a meaningful life, healthy and rich lives. Now, just yesterday, I heard that the British government has actually increased the retirement age from 65 to 67. So as an example, these trends are all going in this direction, whether we like it or not. And in my opinion, we've got 2 choices. We can either plan for it or we can complain about it. But either way, it's happening. The third problem is that our belief systems need to change around money and wealth. So this might be interesting for yourself. It might even be interesting for your children. The marketing that is put out in the world from a larger financial institution has turned the word financial well-being into a buzzword, an empty buzzword. The result, financial industries misuse the word financial wellness to promote financial products. Financial freedom does not require more information or education. We have more information than ever in the palm of our hands, yet people are still unable to become financially free. The reason for this is that we tend to go straight to the have. So have the holiday, have the time off. That's good for goal setting. However, you don't jump from one financial goal straight into financial freedom. We need to move through being, which is the fuel that gets us our belief. The things that we believe take us to our behaviors, and what we believe is what we do. You'll move by doing. and that drives behavior and actions. And these are the vehicles that take us to the have. So why this is so important is that, and I'm preaching to the converted here because we're all part of the mastermind, and on a consistent basis, we are doing the stuff on a monthly basis to get what we want. But you can see the problem with a greater world in terms of financial freedom. Our beliefs influence our behaviors and drive us directly to financial freedom. Information that drives financial information education today tends to go straight to the have. It doesn't pay attention to the behaviors or the beliefs. So we have to change people from just having stuff to the way that they actually work in terms of the emotional parts of the brain. They sell us the dream without substance. So the financial industry, if you go through any airport, this is exactly what they're doing. It's an empty buzzword, something that doesn't feel sustainable. So you've seen this picture, some of you, most of you before probably, but this was me in India in 2018. And the big lesson I learned there was that my father always told me to do my best, do. And the whole paradox of getting results is that, I thought that you if you're going to have, you want to have stuff, then if you have money, then you're going to, you're going to invest, and then you're going to be wealthy. But actually, it's the complete opposite. You need to be the person, you then do the things, and then you have the things that you want. So it's really interesting. And one of the biggest lessons I learned, which I've already spoken about this morning with the Enneagram and wealth, was that with me being a 7, I need to be, who I am. And the more that I'm in my being, the more I'll do what I should be doing. As an example, getting on this investor book tomorrow, and then have what you want. So it's just a really interesting change from doing what you need to do to being who you need to be. So let's go into what the insights are for this. So this is where the opportunity lies. Financial literacy and the social media generation. The generation born after 1985, Alex, this is you, is unique because it has a sense of entitlement, need for instant gratification, and access to easy credit. These characteristics have resulted in a generation that is entitled, egotistical, easily persuaded by social media, addicted to material things, and financially illiterate. The generation needs to make financial literacy an urgent priority. Becoming financially literate creates life-changing opportunities. The generation sets themselves up for failure by not knowing how money works. What's interesting is the reality 10 years from now. The social media generation will make up 75% of the global workforce. They'll be running businesses, education, legal systems, government, and police systems. Their parents will pass on their wealth to them. With this generation's current financial literacy level, they won't have it for long. Becoming financially literate is non-negotiable due to these issues. They don't have financial goals, budget, retirement plans, or emergency fund. They chase instant gratification. They change jobs frequently, gain higher salaries that improve spending power, but hide their lack of skills, financial literacy. They are working just for money lifestyle to impress people. They have no financial freedom. It won't change until they act. The results of becoming financially illiterate. It will free this generation from ego, entitlement, and instant gratification. It'll allow debt, save for retirement, gain an emergency fund, and become homeowners. It'll change their lives and motivation. They'll be able to live a life of purpose. Financial literacy is about being able to understand money and how it works. It starts with understanding that good debt is used to purchase assets and bad debt is used to purchase liabilities. It starts with paying themselves first, meaning 10% or more of their income into savings accounts, investments for the future, and making smarter business decisions regardless of what's being preached on social media. The future leaders of our world need to understand how money works. So I know that for many of you, including myself, this might be a generation behind us. But the point being is that this is not only valuable as a reminder for what we need to be doing, but also for our children. We need to start paying close attention to what people believe about money. Most generational beliefs around money and financial freedom are negative or self-limiting and often repetitive. It's just the way things are. This is important because our beliefs drive our behaviors to financial freedom or away from it. So again, it's exactly what I said to you, be do you have. Almost all information that drives financial information and education today tends to go straight to the have. It doesn't pay attention to the behaviors of people's belief systems. Marketeers and financial industries do not sell behaviors because behavior isn't sexy. We need to start paying close attention to what people believe about money. Life is multi-dimensional. We are complicated creatures. Our financial life does not live in a vacuum. It intersects with all those other dimensions. None of these dimensions are mutually exclusive. Information being available isn't the main issue, but what does matter is the right information available that impacts our belief system. This is a challenge if we want to create longevity and sustainable growth, especially when we don't have the money to throw attention grabbing, so effectively to go after all the advertising over and over more. Furthermore, the 100-year life is a reality, and we must equip people for that. Our mission goes further than transactional. It has potential to do good in this world and to leave a legacy. So let's move on to the next problem. Reasons that people do not invest online or at all. The first one is no trust or faith in the outcomes, inability to tell good from bad, money cost investment outcome, and feeling of incompetency and inadequacy. Reason people avoid investing at all. They're not putting aside money in savings accounts, investing later when they'll have a higher salary, trying to time the market. Investing is too risky. Investing is intimidating, and a lack of investment knowledge. So you can see here that the breakdown, 55% of people don't invest because they don't have money. The next one, 15% don't want to invest. The next one, 8% afraid they'll lose their money. 9%, I don't know how to invest. 8%, I don't trust the stock market. And 4%, I don't have time to invest. Change in the nature of wealth. 50% of millennials will outlive the age of 100 and expect to have gone through 10 to 12 jobs by 38 years old. 17% of people make savings their salary for retirement as a priority. Only 17%, quite interesting, huh? 49% of people do not have a retirement plan. One of the correspondents who said they had a retirement plan, 75% were worried about whether they had enough. So, less than 50% have a retirement plan. And of those 49%, 75% are worried they don't have enough or feel unsure about this. The life expectancy of Fortune 1000 firms is less than 15 years, and S&P 500 is 5 years. 37% of working people believe they will change their careers within 5 years, and more than a third, 35% of middle-class people are not putting any of their salary towards their retirement savings. Some pretty stark numbers there. Change of nature wealth. Nearly 1/4 of Americans are skipping medical care because of the cost. 73% of married or cohabiting Americans say financial decisions are the source of their relationship. PWG found that 1 out of 5 individuals plan their job to switch employers in the next couple of years. A key risk factor considering these trends is that employees on resigning opt to withdraw their cumulative savings. Most pension coverage is actually decreasing with employees changing jobs more often. They failed to choose to preserve their savings, taking the costs on themselves instead. And then the National Association of Real Estate Investment Trust, 56% of the time, REITs outperform the S&P 500 on an annual basis. So just talking about how people can actually invest in REITs and actually outperform the S&P 500. Right, we need to start paying close attention again. The individual investor faces a multitude of barriers to entry and challenges when it comes to building a diversified portfolio. So they're stuck in country. So basically focusing on, assets in that country, massive barriers to entry when it comes to commercial or international. There's huge complexity when it comes to tax, banking, compliance. Everyone knows this. And there's a very low correlation to the public market. So when you're investing in alternative assets, there's a low correlation, but most people don't even understand what alternative assets are. So there's a big change in the nature of wealth, and I assume you will really enjoy this. But if you look here, why are the institutional investors investing in alternative assets? So you would have seen over the last couple of months, we've been through this a couple of times, but there's a big shift. More than 50% of people over the age that have got $30 million or more than 50% of their assets are invested in alternative assets. And these are the reasons that they were looking for them. So if you look here, you've got reduced portfolio volatility, reliable income stream, inflation hedge, low correlation to other asset classes, high absolute returns, and high risk-adjusted returns. So you can see that this is private equity, private debt, hedge funds, real estate, infrastructure, and natural resources. And the majority of the reason, 70% for most of them, was for diversification. So you may be starting to see, if you've understood Alex and myself and the rest of the team, you can now understand why we started to focus back in 2021, 2022 on diversification and alternative assets in terms of the massive trends in terms of where the world was going. So a little history into the alternative asset industry. The first time it came out was in 1852 with the railroad. Then in 1901, JP Morgan basically acquired Carnegie Steel Company. By the way, that's how he became the richest man in the world. Then in 1907, you had the first family office. It's pretty amazing, that, I mean, we're in 2025, so family offices have only been going about 100 years. 1946, you had the first venture capital fund. 1946, you had the first fund of funds, so effectively a mutual fund. And then in 1949, you had the first hedge fund. So it just gives you an idea of how things have evolved. And again, I will share these slides with you if you want to go and read all the detail in terms of the process. The growth of the alternative asset industry, you can see here in 2010, it was 4.1 in terms of the trillion assets. And you can see the growth of it now in terms of actually in the region of over 17 trillion and continuing just to grow. It's growing. CAGR is the average growth per year of about 9.8%. So this is a long-term trend. So you can see why we basically focused ourselves on global diversification and alternative assets, because there's a significant opportunity in the space globally. Now, you've all seen these slides, so I'm not going to go into them in detail, but the old system is broken. When Jill and Joe Soap want to go and invest in a property, there's 16 different middlemen through the entire process, no trust, no transparency, high fees, no returns, low alignment. And if you try to go through the financial industry, there's just multiple fees all the way through the process. You don't really have exposure to the underlying asset. You really are tied. There's a higher than 70% correlation to the stock market. And finally, even though you think you're investing in property, you're actually not. You're investing in the secondary market, which is the financial markets. And the stock market goes up and down all at the same time. And if you try to do it on your own, then this is a good depiction. There's 16 middlemen between you and your investment. There's high minimum investments, and it's very difficult and complicated. So what are the type of returns? Well, this is the value chain of real estate, which again, I've taken you all through before. But land developer is looking at 30%, a developer 25%, an investor 20%, a fund or a REIT's looking at 5 or 8, and then the average person's wondering why they're battling to beat inflation. And the question should be, how do you actually go up the value chain? And the problem is that most people can't. So 13% of the world has access to residential property, and of that 13%, only 1% has access to commercial real estate and alternative assets. So I've just shared with you all the massive trends around the world and how all the biggest investors are moving into alternative assets, and yet most people don't have access to it. It's all within the primary market, which is direct investment, and it's the secondary market that the majority of the world actually has access to at the moment. And then finally, in terms of the returns, this is an interesting one. You've got an average return. We've managed to get an average return for the last 10 years of about 14%. Funny enough, Calio Capital, with their family office, has also got about 14%. The stock market has got a return of about 8%. Private equity has got a return of about 12% on average in terms of it. So it just, again, shows you the attractive returns of the primary market versus the stock market. And then I'm not going to go into this today, because I think most of you already know this. If you do want to, in the fireside chat, I'm going to go into this in more detail in terms of how we've then gone and positioned ourselves as a unique offering. But in simple terms, we've made it easy to invest in America, Europe, England, Australia, etc. Easy access through the Meta marketplace. So you can go through Wealth Migrate, Private Wealth Global, Farmers and Wealth, Golfers and Wealth, Women and Wealth, etc. You've got trusted anti-money laundering, AML, and KYC So we've automated that entire process through Lemonway, compliant licensing and tax structure, European compliance. The entire investment takes place on a secure digital platform. You can invest from $10, and it's one platform. So rather than the complexity of investing in England, Australia, America, Europe, you can do it all in one place in terms of that process. So that's where we're at. So what we decided to do was to build the future of wealth. And I don't know if you like this little heat map, but this is where our investors are. So we've got over 7,000 transactions from people in 71 countries. Do me a favor in the chat box. I quite like this. It's quite impressive, this heat map. When you look at where the investors are around the world, investing in the deals. Clearly, we need to figure out how to get a little bit more into Asia, I would say, and in South America. But it's quite interesting when one looks at the heat map of where we've got our investors around the world. So yeah, we really do consider ourselves to be a global platform, and to our knowledge, we're the only one that is focused on diversification and specifically in the alternative asset space. So let's take it now. And why is this relevant in terms of the 100-year life? And this becomes really, really important. So since 1840, there's been an increase in life expectancy over 3 months for every year. Okay, so you can see here, this comes from the book that Alex was referring to, the 100-year life. Today, millennials have more than a 50% chance of living to 100. And since 1840, there's been an increase in the life expectancy. Did I repeat that? Yeah, I'll repeat that. Sorry. So you can see here, so look at this life expectancy graph, literally since 1840, and how it's just increased. And basically by 2050, the average person is expected to live 100 years. Interesting, eh? Now, 2050 felt like a million millennials away, but it's actually only 25 years away. Alex will be 50 by then. I'm going to take some time to read through these, but I'm also not going to go into the detail because as Mastermind members, I've actually taken you through previous sessions where I've explained to you the 16 macro trends. I've explained to you exponential technology and exponential organizations. I've explained to you Society 5.0. But what's interesting here, according to the founder, executive chairman of the World Economic Forum, we stand on the brink of a technological revolution that will fundamentally alter the way we live, work, and relate to one another. In its scale, scope, and complexity, the transformation will be unlike anything humankind has experienced before. We do not yet know just how it will unfold, but one thing is clear. The response, it must be integrated and comprehensive, involving all stakeholders of global polity, from public and private sectors to academia and civil society. So, as a reminder, the Industrial Revolution was water and steam. So that's where steam and water replaced human and animal power with machines. The second Industrial Revolution was electricity. Electricity, internal combustion engines, airplane, telephones, cars, radio, mass production. The third Industrial Revolution was automation. Electricity and the internet, IT used for automation of mass production. And the fourth industrial is cyber physical. So driverless cars, smart robotics, materials are lighter, tougher. So this is all the exponential organizations I was talking about. Now, this is the most important slide.
I don't know how much time we have, but could I just quickly speak to the slide for literally just 2 minutes? I'll try and keep it quick.
Please do. Just remember, obviously, that I'm wanting to. I've run entire sessions actually on these changes and shifts already.
Yeah, I love this slide. I have spent, ladies and gentlemen, hours on the slide, obsessing about the slide. So, like, seriously, and one of the key things that I always find, my key takeaways here, is if you look at the first industrial revolution all the way up to the fourth industrial revolution, think of the way that we've invested over the last 100 years, and think of the way that we as a company, Wealth Migrate, has now basically enabled all of us to invest currently. So when you think first industrial revolution, I don't know, you probably had to have a lot of money, you had to be wealthy to be able to invest, right? The second industrial revolution is where it was actually accessible to access the stock market. Think of the 1920s, 1929, the great, Black Monday, et cetera, et cetera. But that was where the market, or let's just call it the world, was able to actually be part of this investing world. And when we find ourselves here in the third industrial revolution, on the brink of the fourth industrial revolution, that is where the secondary market, and most of you now have gone through this, is where you were able to buy shares on a stock market, own a piece of a property through a REIT, or now through our platform, able to actually be part of investing in a property and actually owning an underlying asset. And I think fourth industrial revolution, things that we've now started hinting towards, the Enneagram and wealth, or Enneagram EQ, where we're building funds, or we're building these ecosystems where it's not about cool investing. It's not about a shiny vehicle. It's actually about you as an individual, understanding your psychological ways of investing. Again, Enneagram 8, I'm a power investor, so I want to be part of a larger why. I'm a 5, I like tech. So think of that, and then think, if we then take another step back, like where we've come from, where we are right now, and where we're going towards, where AI is now integrated as well. We can probably talk for hours about this, but it's just a nice way of thinking about the way we've gone from where accessibility to investing was only for the rich and famous, to where it was, you could only invest in the stock market and have high volatility, low returns, to where we are right now, where it's actually not even about investing. It's about like you as a person and how you want to actually show up when investing. Scott, I won't take more time, but I think it's a very important point to mention to everyone here, is because we're on the cusp of very cool things.
Yeah, no, look, it's a challenge when Alex and I get going on this, because we really are, over the last couple of months, what we really have done is we've lifted the hood into why we're so passionate about what we are building together, why I'm so excited about the Mastermind, and actually how we're trying to really go deep in terms of substance. I think one of the challenges that I often have, and I think Alex probably shares this as well, is when you've studied something for 28 years, there's so much knowledge and so much substance that you don't want to overwhelm people, but I do want you to understand what's going on in the world, and to help you so that you can make the right decisions for you and your future, but also you can understand where we as a company are coming from. Now, to take what Alex just said and to take all of that, because now we spoke off. So the first part of the session, I went through what the problems were. I showed you what the challenges are with millennials' behavior, but to be fair, there's many people in my generation that have the exact same behavior issues. And then I showed you that it's not about having the things, it's about being the person. So now let's look at why this is so important. So in every global society, there's an increasing likelihood of living to 100. Financing longer lives, living complex and challenging governments, corporations, and individuals. And ultimately, financial advisors and alternative financial solutions will need to play an essential role in helping individuals successfully finance longer lives. Remarkably, every generation is living 6 to 9 years longer than the previous generation and staying healthier for longer. So let's look, and I would strongly recommend that you screenshot this slide, because this is the most powerful slide that I saw when this was presented to me a couple of years ago. So if you take the old economy, our lifespan was about 75 years old. And the way that we did it, we were taught to work. So we went to school and university and we got a good job. Then we went out in our 20s and we started working for a company. If you like, my grandfather, who worked for ANCI his whole life, he literally worked for them his entire life. And he worked. And then he retired at 65. And the idea was that you then go into retirement, you start to eat off your capital, and you kind of hope that you die before you run out of capital. Does this make sense so far? Okay. Now, the problem with this curve is that I had a very stark conversation, and I'm not going to mention who it is because it's personal to my own family. But let's just say it's someone who's basically married into our family. Now, this gentleman was an optometrist. He's been, funny enough, my optometrist since I was a young boy. And, so he's done everything that he was told to do. I mean, he went to school, he went to university, became an optometrist, an eye doctor, if you don't know what an optometrist is. He ran a very successful practice. To my knowledge, he didn't do anything stupid or dumb. He invested, he bought property in London. He lived in South Africa, but he bought property in London. He was originally from Zimbabwe, but the point being is he did everything everyone was taught to do. And I had Christmas with him about 2 years ago. He's 82 years old. He's very healthy at the moment. And he literally looked at me and he said, Scott, I'm getting really worried I'm going to outlive my money. Because he's basically now living off capital. And him and his wife are happy and healthy. They're in their 80s. He's still playing golf. I don't know, for you golfers, I didn't even know this was a thing, but you try and now beat your handicap. Garth Milne can probably tell us about this, but there's a big thing where as you get older, you try so at 82, he's trying to beat his handicap in terms of the process. And, it kind of shows you that the gentleman's still healthy, etc. But it's actually a very negative story because he spends his life in fear of he's basically, and you hear me talk about being financially trapped. That for me, Garth, beating your age. That's exactly what he talks about. And what's so important here is that this is the proverbial being financially trapped. So even though they're healthy, both him and his wife are healthy, they want to be able to go and visit so it makes me emotional, but visit their kids and grandkids. Like they're scrimping, they live in St. Francis, but they don't want to drive to Cape Town because it's too expensive. And, they can't stay in their house in St. Francis over Christmas because they need to rent it out so that they can pay their rates and taxes for the year, And the frustrating thing for me is that they did everything that they were taught to do. And they trusted the financial industry. And this is the system, and it doesn't work. So if you take the new economy, what needs to happen is that basically you've got a lifespan of 90 years plus, as we've said, proved it statistically to probably an over 100. And this is where you've got to basically go out and you've got to learn. And then, and you've got to see on the right here, you've got engage, which all of you are doing. And congratulations to all of you here. You've got to invest, you've got to grow, and you've got to protect your wealth. And sometimes you've got to recondition, you've got to learn something new. Maybe like me, at a young age in my 20s, I went out and I learned how to buy houses, and I bought 16 of them. I was like, wow, wow, I'm really good at this. And then I thought, obviously I started to learn how to do it more, and I bought 60. And then suddenly it was like, oh, hang on, residential houses are quite a crap investment. Sorry to be direct, but they are. And I was like, right, I need to recondition. And this was me, say, around 2014. And I was like, oh, wow, now I need to kind of sell off my residential houses, and I need to start investing, in much more in commercial property and other, for now it was only commercial property. And I was learning off people, I was going on courses and everything else. And then suddenly someone came along to me and said, oh, no, hang on, Scott, but what about structured notes? And I was like, what the hell is structured notes? And I learned about structured notes, and I had to learn again. And then I started investing in other alternative assets like private equity and debt and everything else. And let's hypothetically say that I'm somewhere here in this curve. I don't know. I have no doubt in my life that there are multiple reconditioning moments coming up over the period. But does this, a lifetime of continuous wealth growth, which is a combination between knowledge, the people you're hanging out with, investing, and relearning, reconditioning, does this make sense? Marina says she loves this. This graph, these two little graphs, were some of the most valuable graphs I've ever seen in my life, because this is where it all became real to me in terms of this process. So just do me a favor in terms of in the comments, if this makes sense to you, because this for me, Alan, you've spoken a lot about the financial industry and the challenges with the financial industry. And just by the way, I don't want to badmouth the financial industry. I think it was built, as I've just proved to you, in the early 1900s. And it was built for a working class like my grandfather that were going to go out and work for ANCI, a corporate company, for 40, 50 years. And my grandfather died, I think at 76 to be an example. So my grandfather was literally the proverbial person. He went to school, he went to university, got a job for ANCI, he paid off his retirement. And then, you know, his money kind of looked after him until he died, and he died, like, end of story. But the world's changed. And you know, my grandfather can't try and exist. It doesn't work in this environment. And for someone like myself or all of us on this call, but even more so for Alex, this is why this reconditioning. And Alex, this is why you're going to be successful no matter what you do, because you keep reinvesting in yourself. Like, just for the record, just to tell everyone, and I hope you don't mind me sharing, Alex, but it was a long weekend this weekend in South Africa, and most people took the weekend off. I guarantee you that everyone, Alex is 30 years old. I guarantee you everyone that was Alex's age took 3 days off, partied, and had fun. Alex, how much personal development did you do this weekend? Like, I know you did a lot, but I don't know the hours, but how much was it actually?
A bit embarrassed to say, but probably about 8 to 10 hours, I think, give or take, over the weekend.
Yeah.
Yeah.
And none of that was, you know, I didn't ask him to do that or anything. It was all completely, he wanted to learn new stuff, etc., in terms of that process. So that's his process. So, okay, so now let's look at what this actually means. So as our life expectancy increase, financing the older challenge of ourselves is a challenge. So what do we actually do? We must find a way to enable the current population of young and middle-aged citizens to be the healthiest older generation in the future. They need to be healthy, active, and financially secure in their old age. So how do we shift this? So I'm about to give you some very stark stats here, and I know Anthony's joining us. And again, I remind you, after Anthony's joined us, I'm actually going to go into the investment philosophies of what you do with a 100-year life. But let me give you some stark stats before he arrives. Living longer means that there are more productive hours per life. So someone with a life expectancy of 70 has 124,800 productive hours over their lifetime. The number of available hours to someone is almost 100,000 more, so 218,000 if you live to 100. So what will you do with all these extra hours? Just by the way, if you look at that, that's like 40%, like 40% extra. It's unbelievable. And that's why you need to rethink the three-stage model of life. So in the old days, it was get an education, work for 40 years, and then retire for 20 years or so. We may add stages such as part-time career transition, or making midlife crisis. But in simple terms, it's 3 parts: education, work, retire. The new type of life, it'll require a mindset shift. So we need to look at savings, relationships, health and vitality, education, skills and career, and even our purpose. Do you understand why I did purpose 2 weeks ago? Our financial advisors, financial services will need to support individuals through their changing needs. So we'll talk about this after Anthony, but Alex has already alluded to it. And well done, Alex. I really appreciate you having the understanding, actually. But when we do the Enneagram and wealth, and one of my biggest takeaways from the Wealth Weekend, God said something. He said, most financial plans are built around models and numbers. We build financial plans around people. Does that make sense? That's why the Enneagram and wealth becomes, I don't know why I got a little thumbs up there, but anyway, that's why the Enneagram, and even my computer thinks it makes sense in terms of building it around people. The most critical need is to fund a longer life, either by working for longer or by saving more. Okay, so what does this actually mean? In the 3-stage life, you've got a life expectancy of around 80. You can work until 65 while saving a manageable portion of your income towards retirement. If you live to 100 and only work to 65, that portion of your income will need to save your funding for 25% of your annual income, which is unrealistic for most people. In this scenario, you need to work 44 years to be in retirement for 35 years. Supporting the 100-year life means savings, property, and pension, and the intangible productivity, vitality, and transformation. People will work into their 70s and 80s, possibly transitioning into new careers, flexible roles, or gig work, a job that lasts for a specific period. Work before retirement will become more fluid as people enjoy leisure time throughout their lives. In turn, retirement solutions will have to adapt because simple accumulation and decumulation of products will no longer serve clients. And then the biggest challenge is to avoid running out of health and wealth. So One solution may be longevity insurance, where health and wealth products converge to minimize certain risks. Individuals can insure against risk of outliving their assets, health, skills, relationship, and sense of purpose. This already aligns to medical aid companies such as Discovery, when its purpose of making people healthier while enhancing and protecting their lives. Individuals can insure against risk. So let's look. We need to work with our clients to plan for a healthy, meaningful life, not purely focus on retirement savings. So this becomes really, really important, because when you look at the mastermind as an example, often people sit down with me with the outcomes and they say, okay, Scott, is this all financial? And I'm like, no. Very often people come up with life, career, purpose, health goals. One of my health goals this year was to get a lot healthier. And that's why for me, wealth is much more than what I learned from Roger Hamilton. It's much more than just money. Trying to engage people by telling them they need to save more doesn't work. If you consider their future in terms of health, relationships, and skills, it helps people to think more concretely. Get a 20-year-old to think about themselves at the age of 30, a 30-year-old to think about themselves at 40. This helps them to broaden the conversation. So basically, critically, institutions and individuals worldwide need to solve the longevity challenge. The advisor's role will be to help ensure longevity is a gift, not a curse for clients. So that's why we've got, as an example, the Freedom Calculator, because what we do is it's a simple little tool. And if you haven't used it, where's it gone now? It's a simple little tool where someone can go along. Obviously, the ALM that Anthony does is a lot more sophisticated, but this is a simple tool where someone can work out, like, right, where am I at? How old am I? What is my passive income number, and how do I actually get to that passive income number? What is the point of all of this? And it's perfect timing as Anthony arrives, and my timing I'm quite impressed with. So the point of all of this is this final graph that I wanted to share with you. And I'm going to just go into this in a little bit of detail. I printed some stuff out for you here. So where's it gone? Just give me 2 seconds. So I just want to explain this graph to you, and then I'm going to hand over to Anthony. So again, one of the more powerful graphs that I've seen. So if you look here on the left, you've got pace of learning. So this is low pace, high pace. And then you've got novice investor, seasoned investor, and experienced investor. How do we redesign wealth creation for investors? So let me just explain this to you. So if a macro, so you can see here basically, so you got macro. So this is big picture concepts. So this is strategy, risk management, diversification, and mindset. Then you got micro, which is tactical knowledge. So specific assets, deals, market timing, technical skills. Then you got credentials. So you can see credential here. This is formal education or certification that typically provides validation, but may not accelerate pace significantly. Maybe that's becoming a chartered accountant, an MBA, studying something. And then you got a coach, which is a personalized mentorship, accelerates learning significantly, especially in the later stages. So let's just look here quickly as a novice investor. So if you're over here, you're a novice investor. So you need to start learning about the macro, the big picture. Then you progress into the micro, like what are the different asset classes, how do markets work, et cetera, et cetera. Then the pace of the learning, it rapidly increases because you learn about supply and demand and whatever. But then it starts to fall off as you become a seasoned investor. Now, at this level, often shifts back to macro thinking. So again, you start thinking like, should I be investing diversifying internationally, whatever. The pace of the learning declines here unless new strategies are adopted. And many get credential here. So they go out and they try to get a degree or go do a course. This was me, by the way. I've done multiple degrees and courses. And then you've got a divergence because the normal pace of growth is the green, okay? Where people just kind of continue to do what they've always done. Some investors maintain a steady pace of learning improvement in terms of the process. The bad, which is the red, is where stagnate or regress, perhaps due to overconfidence or outdated thinking. And then the blue, which is what you're all doing, is that a few re-engage deeply in the micro level with guidance, often through a coach, and see a sharp increase in results and understanding. So the reason I wanted Anthony to hear this as we're about to pivot into him is that this is what Anthony's doing for us every single month. He's coming in, he's checking in, he's giving you a market update, he's teaching you what's happening in the market. Every month, I'm coming along and bringing you either myself or some other seasoned authority to teach you something. And so every single month, you're making this process. And that's how you get to this experienced investor, those who leverage coaches and mentors to become great investors. And this is where the real breakthroughs happen, often combining macro and micro through lived experience. So what do you think of that? I love that little graph and that analogy. And with that, Anthony, it's time to pivot to you so that we can not only learn from one of the best coaches I know, but also our micro understanding on what's happening in the market. And just to remind everyone, when Anthony's done, I will then go into the three other areas, like what do we actually do with the information? What are the strategies we do for the 100-year life? And how do we implement it? But over to you, Anthony. Welcome and thank you for joining us.
Thanks, Scott. Sure. Quite a compliment given how many coaches you know. Thank you for that. I appreciate it.
Dude, it's not, I don't give compliments out lightly. I've learned more from you by attending these sessions in the last 2.5 years than many other sources. And I mean that sincerely. And you've truly helped me learn how it's happening, how the game's been played at the top 1% level. And that, for me, I'm truly grateful that I get to experience this every month.
Awesome. Thank you, Scott. It's a pleasure. Alrighty, let's jump into it. I'm going to share my screen.
Where's Anthony gone?
Can you see me and can you see my screen?
Yeah, I'm just pinning you so that everyone can see you properly. Yes, I can see your screen. And you should be, so everyone should be able to see. Oh, hang on, what have I done there? Have I got, everyone should have Anthony pinned on his screen. Can you see that? Yeah.
I see some heads nodding. All right.
Okay, rock and roll, dude.
Cool. Alrighty, we're looking at May, a very interesting month off the back of quite a turbulent April. We'll go through everything in the usual format. Firstly, looking at our indices on a monthly view. Like I said, this will be for the month of May. And we're looking at these indices or indexes in their base currency. You can see there off the bat, a very strong return from the S&P 500, up 6.3%. The DAX, which is the German index, also posting a strong return, up 6.7%. The FTSE 100, which is the UK, up 3.8% in pounds. The Nasdaq having a stellar month, up 9.1%, really rebounding nicely there during the course of May. Both Chinese indexes in positive territory. The Hang Seng, the better performer of the two, up 4.7%. The ASX 200, which is Australia, up 4.2%. And the Russell 1000, which is a broader S&P 500, up 6.4%. You can see there that the general mood for the month of May was a positive one. So really good to see. If I jump to the next chart and I look at everything in US dollars, telling a similar story. We did see a little bit of dollar depreciation relative to the pound throughout May. You can see that they're pushing the FTSE 100 return up slightly to 4.8%. US dollar euro was relatively flat throughout the month of May. We had seen some depreciation there throughout April, dollar depreciation, but that seemed to have stabilized throughout the course of May. So the returns there pretty much the same as if you look at them in US dollars. Same thing with a little bit of dollar depreciation against the Australian index, the ASX 200. You can see in dollar terms that jumps up slightly to 4.8%. And our dollar-based indexes like the S&P 500, Nasdaq, Russell 1000, as well as the Hang Seng, all remaining the same. Again, no matter which way you look at it, some really strong returns across the board for May. Jumping to the next chart, looking at things on a year-to-date view. So as a reminder, that runs from the 1st of January 2025 up until the end of May. We can see there, I mean, one can very obviously see the shock over the first 2 weeks of April. You can see quite a significant drawdown there across all of the indexes. But really what you're seeing throughout May is a continued recovery post those initial declines in early April. So we did see some of that recovery play out in April. And we're really seeing an extension of that recovery in May. For those of you that have been watching the news and watching the indexes, that recovery has continued to play out throughout the course of June. So there's some good momentum in the markets at the moment, which is really good to see. You can see the US indexes, S&P 500 up 1.1%. When we looked at this last month, they were in negative territory on a year-to-date view. So we're seeing a lot of this year's negatives start to wash out of the US. And like I said, that momentum has continued throughout June, which has been really good to see. The DAX continuing with its strong return in euros, up 20.5%. The FTSE up 9.4% in pounds. The Nasdaq also breaking through into positive territory, up 1.9%. Hang Seng, Chinese index, up 16.8% in US dollars. That has recovered significantly. I do have a bit of commentary on that with regards to trade deals reached between the US and China, but that was ultimately the main catalyst for that. The Hang Seng started off the year really well. You can see it's that dark blue line at the top. And much like the other indexes, it wasn't immune to the drop or to the sell-off in April, but it's since pretty much recovered most of those losses. Australia, the ASX 200 up 5%, and the Russell 1000 also breaking through into positive territory, up 1%. Looking at things in US dollars, this is probably on a year-to-date view is you see a bit more of the dollar depreciation. You can see there the DAX up 32% in US dollars, the FTSE up 17.8% in US dollars, as well as the ASX 200 up 9.1%. So quite an interesting dynamic at play there. I think it's something cyclical. I don't think the dollar's broken. It's something that we've been talking about and alluding to for some time now. Just seeing the dollar kind of depreciate slightly. It's been far too strong for far too long. So you are seeing what I believe to be a very normal unwinding of the US dollar within this cycle, and you'll see that re-rate in the future again. Keeping in mind that currencies by nature are cyclical. They have their time in the sun and then they kind of fade away a bit, and they move through in cycles. So yeah, very, very interesting to see that most of the indexes have rebounded very strongly post their April drop. And of course, as investors, long may it last. There are a few risks on the table at the moment, which I will address shortly. But ultimately, the world seems to be in a fairly good place at the moment, like I said, bar some risks. Most of those risks are war related, keeping in mind that we have seen escalations in the Middle East over the weekend, as well as an ongoing war between Russia and Ukraine. So that is certainly something that we're keeping an eye on. But from a valuations perspective, from a company perspective, in particular the US, things are looking good. Having a look at the asset class returns for the month. Again, another interesting story here. You can see growth leading the charge there at 8.7%. No surprise there, given how well the Nasdaq performed throughout the month of May. So growth leading the charge. Developed market equities coming in at 6%. Our interest rate sensitive sector, small caps, posting a nice return there at 5.9%. Emerging markets, as a result of China's strong month, up 4.3%. Value slightly behind for this month, but on a year-to-date view, still near the top and second place there at 6.9%. Global real estate investment trusts, nice positive return there of 2.7%. The global aggregate, which is a global bond market, under a little bit of pressure for the month at negative 0.4%. However, still on an annualized basis, looking quite strong there at 5.3%. And commodities at negative 0.6%. Again, on a year-to-date view, looking strong there at 3.1%, as well as small caps on a year-to-date at 2.8%. Interesting to see that on a year-to-date view, everything has pretty much moved into positive territory. I'll remind you, when we did this last month, it was not the same picture. You still had quite a strong hangover as a result of the sell-off in the first 2 weeks of April. Make no mistake, I know we spent a bit of time on it, but that sell-off was deep and it was quick. I think people are very quick to forget just how severe it was. But there were stages where we were flirting with a technical market crash. The S&P 500 at a stage during one of the sessions, I calculated it at negative 19.5%, which is 0.5% away from a technical crash. A crash would be negative 20% or more. So that drawdown was severe. And obviously the recovery post that has been really strong, keeping in mind that indexes have now moved into positive territory. So very interesting to see how that all played out. In terms of what actually happened throughout the month of May, May was really characterized by a broad rotation back into risk assets as equities and high yield credit rallied following the partial rollback of tariffs announced on Liberation Day. Liberation Day was the 2nd of April. That was the day that Trump took to the stand and started rattling off a whole host of tariffs on pretty much every single country in the world. This easing in trade tensions helped reduce recession fears and supported a rebound in market sentiment. Couple this with improving consumer sentiment and April's low base as a result of the market sell-off, you had the perfect storm for strong monthly performance in equity markets. The S&P 500 led global equity markets in May amid a broad-based rally. The technology sector outperformed. However, the rally extended to cyclical sectors such as industrials and consumer discretionary as well. May's performance marked a significant rebound from earlier in the year, dragging the index into positive territory on a year-to-date view. It does still lag some developed market peers on a year-to-date view. However, this catch-up has continued to play out throughout June. So there does seem to be quite a sharp catch-up at play between the US indexes and its other developed market peers. And that's really off the back of really strong earnings in the US. So that's, the first quarter earnings season is definitely what's underpinned that strong market performance. So with 97% of the S&P 500 companies reporting for quarter one as at the end of May, the blended year-over-year earnings growth rate was 12.4%. That's high. 12.4% year-on-year growth rate for the biggest companies in the US, if not in the world, is a substantial number. These companies are growing and they're doing exceptionally well. This marked the second consecutive quarter of double-digit earnings growth for the index. Notably, 77% of companies reported positive earnings and 63% exceeded revenue expectations. So these were a very strong set of numbers. I can't stress that enough, how well these US businesses are actually doing on paper with regards to their earnings results. So it's no surprise that when you look at these US businesses from the bottom up, they are looking very attractive. So from a valuation point of view, these companies are looking strong. However, it is the macro tariff-related risks that one needs to try keep an eye on, along with conflict escalation risks stemming from the Middle East. So whilst if you just isolate the specific company in the S&P 500 and you have a look at it, it's probably going to look very attractive. One does need to keep in mind that there are various macroeconomic or geopolitical issues at play, and those should be understood and monitored as one of the key risks at the moment in the market. In Europe, markets also had a very strong month, adding to their already impressive year-to-date gains. Advancements in US-EU trade talks helped to alleviate fears of recession, while expectations for fiscal support and upward earnings revisions continue to underpin regional sentiment. Really good to see those talks looking quite positive between the US and the EU. They have made some adjustments in terms of the interest rates, which I will touch on shortly, to try and help just alleviate some of the pressure as a result of the tariffs. I will touch on that shortly, but there is still one or two growth risks that we are watching in Europe. I don't think they're out of the woods yet, despite a really strong equity market performance. In the UK, markets finished in positive territory but lagged peers for the month. UK-listed pharmaceutical companies came under pressure following Trump's drug pricing reforms, which threatened revenue from US sales. At the same time, persistent inflation and competitive pricing make it harder for staples to pass on rising input costs. Utilities also struggled, with rising UK bond yields reducing the relative attractiveness of dividend-paying stocks. So basically, some of the bigger businesses in the UK are struggling to pass on price increases to consumers. They're having to take a lot of it on the chin, which is obviously denting their revenue and their profit margins. So that is something that we're also keeping an eye on. With regards to China, China also posted some really strong returns for the month, still riding high on the de-escalation of earlier tariff wars between the US. So that catalyst that we saw earlier on in the year continues to help drive equity markets there. I also have another chart on that. It's just interesting to see how quickly the escalation between those two giants evolved, and pretty much where we're at today. But bar anything major, China still looks to be, or continues to look, relatively attractive. There are obviously some risks there, but because of that de-escalation, a lot of those risks have gone out the window. But that, from a tariff point of view, I think things are far from over. We are in a 90-day truce window. However, there is still obviously the ability for tariffs to be reignited post that 90-day truce. So that still remains kind of front and center as one of our key risks. Jumping to the next slide, looking at just some charts that I found interesting throughout the month. Our first chart, top left, this looks at the running total of executive orders signed for various presidents throughout their presidential term. In blue, you've got Barack Obama. In light pink, you've got Donald Trump's first term. Dark blue, you've got Joe Biden. And then at the bottom, in the darker pink, you've got Donald Trump's second term. You can see that line at the moment is almost vertical, meaning that he's ultimately just come in and signed a whole host of executive orders off the bat. I think there was a point where he was bragging about how many he was signing on a daily basis. But you can see that there in the numbers, that is an extreme amount of executive orders. This erratic US policy, based on the extensive use of executive orders, creates uncertainty in the market. They don't know what he's going to sign. They don't know what he's going to do next. They don't know what he's going to approve, what he's going to disapprove. as we've learned, the market does not like uncertainty. They like to have a good idea of what's going on and what they can expect. So this is definitely where some of the more macroeconomic risks that I alluded to earlier stem from. You've got a president of the US that is fairly hot-headed and fairly erratic in his decision making, whilst it does seem to have been contained of late. One still needs to understand who they're dealing with and the risk that that does present. So just a nice chart there to show just how many executive orders have been signed in these initial days. The second chart, top right, this looks at the relationship between US bond yields as well as the equity market. You can see there the little gold dot is where we currently are in terms of 10-year bond yields. Why this is important is that historically there has been an inflection point just over 5% in terms of bond yields, where markets or the S&P 500 is happy up until a certain point, and then they start to get the bond yields start to put equity markets under pressure. So again, this is just something else that we're kind of silently watching in the background. There's no issue yet. So far, yield increases have been gradual, which is fine. However, if these yields increase too much too quickly, we could see a spooked equity market. So like I said, historically, yields greater than 5% have marked that inflection point. At the moment, we're at, if I'm not mistaken, around 4.2-ish, 4.3. So there's still quite a way to go. You just don't want to see a bond market moving too quickly up until up to 5%, which would ultimately put equity markets under pressure. So there is quite an interesting dynamic at the moment playing out between the bond market, currency market, as well as the equity market. So again, that's also just something that we're keeping an eye on. The third chart, bottom left, looks at the European Central Bank and rate cuts. They cut rates by a further 25 basis points at the beginning of June. That takes their deposit rate down to 2%, which is the dark blue line here. The reason why they did that was because the economy needed it in order to help stimulate growth as they grapple with the uncertainty of the impact of higher tariffs. Whilst the European Central Bank has opted for a meeting-by-meeting approach for further rate cuts, the likelihood for further cuts remains high. Despite equity markets doing well, Europe still has growth issues. They need to cut rates to stimulate growth to continue on this trajectory that they're on. The chart below just shows various forecast as well as what the consensus is implying for future rate cuts. It looks like we will see at least 2 more rate cuts this year coming out of the Eurozone. So I wouldn't be surprised if we saw that deposit rate dropping down to around 1.5 at minimum. So just interesting to see how that will play out. In terms of US interest rates, it's probably a question on a lot of your minds. It's still a wait and see approach by the Federal Reserve. Some people are starting to price in 2 rate cuts that will happen before the end of the year. But again, the Federal Reserve, much like the ECB, is on a wait and see approach. No one is quite sure just yet how these tariffs will increase their respective economies. So I think the guys are just kind of sitting on their hands, trying to understand what the data is telling them before they make a move too prematurely. Remember to cut rates and to kind of a couple of months later say, oh, sorry, I made a mistake, we need to increase them again, would be a really, really bad signal for the market. So no one wants to move too soon without having a complete and full understanding on what the data is telling them. Lastly, the chart on the bottom right, basically just talking to what I was saying just now about the tariff increases between the US and China. You can see I mean, this kind of spike here is when um, they were just going tit for tat, the US and China. It was like an hour later, China retaliates, then an hour later, the US retaliates. And really, this just kind of cascaded or escalated to a point where it was actually quite comical. I mean, it was so bad, it was funny, and it happened so quickly. It was honestly comical that at a stage they were well above 100% each. So you can just see there how that kind of blew out of proportion. Fortunately, we saw that deal being reached in Switzerland over one of the weekends a couple of weeks ago. And we saw those tariffs come right back down, as well as a truce for 90 days. Um, However, I mean that at the time, whilst comical, if that had to stay, that would have posed significant global risks for pretty much everyone involved. Um, so whilst it's not an issue at the moment, it's definitely worth something worth watching. If there were to be any kind of re-escalation post this 90-day truce, it has the potential to put China's exports under renewed pressure, and that would ultimately put the rest of the world under a bit of pressure. So that is something that we're also watching quite closely. For the time being, the US and China are actually they're playing in the sandpit quite nicely together. It's not something that we see every day, but there seems to be a mutual understanding at the moment that tariffs are bad for both countries if they are to increase to those higher levels. So again, just worth noting, worth understanding just how bad that was, and just how much damage it could have done had that remained. Um, but again, it's something worth watching, because clearly both of these guys are willing to go the distance if provoked. We've seen it before. So just yeah, hoping that we don't see it again, and some kind of um, yeah, they take a more educated kind of approach to it. I think that's certainly something that I'm starting to pick up within this kind of, I wouldn't call it the second half of the presidential term, but this kind of presidential term post the initial tariff announcements. It seems to be a lot more calculated. It seems to be a bit more calm in Trump's approach. It's not just slapping everyone with tariffs and dealing with it later, um, which is obviously a very positive thing. You've got a guy that's approaching things with a bit more maturity. From what I've seen, one of the key directors of tariffs has been removed from the picture. He was known to be very aggressive, very gung-ho, and they're now approaching it with a team that seems to be a lot more level-headed and a lot more mature and calculated in their approach to tariffs. So again, all positive developments so far. And that is me.
Anthony, thank you very much. I wanted to ask you quickly, was the person who was gung-ho on tariffs Elon Musk?
No, it actually wasn't Musk. There was another advisor.
I'm sorry, I'm taking the piss. You
Yeah.
said someone that was hot-headed and gung-ho. The first car that came to mind, you know.
I'm not sure he was helping the situation. I feel like there was quite a bit of input from him, whether it be corridor chats or whatever that might have looked like. But yeah, they had quite an aggressive group of guys initially when all of these things were announced, and then we kind of saw a replacement. The one guy, I can't remember his name now; it's just completely slipped my mind. But he actually didn't get invited to the weekend with all the meeting with China in Switzerland, and they were able to walk away from that with a deal. So I don't know what that says about the previous guy's negotiation tactics or his approach to tariffs, but we're in a much better position at the moment.
Awesome. So if anyone's got any questions, ping them through. I've got two questions for you. The first one is that it's actually quite scary, but we are 12 days away from the end of the half year. Any sort of thoughts on where you see the next sort of 6 months going as an investor?
Yeah, I think I would be I don't think we're going to see the magnitude of volatility or the drawdown that we saw in April. I believe that that's kind of come and gone, that severe market shock drawdown of 19 odd percent. Um, I think that kind of knee-jerk reaction is out of the system. I do think. I mean, I must be honest, I'm cautiously optimistic for the rest of the year. I think we've seen the developments around this whole tariff related issue seems to be positive. The way the US is approaching things at the moment. But again, like I said, I do think there are risks in further escalations in the Middle East. I'm sure most of you guys know that really kicked off again this weekend. I know Trump left the G7 earlier than expected to try and deal with those issues and to try to come to some kind of peace agreement between the two nations. A risk is that these guys just don't listen to them and they just continue as they have been, which is actually starting to look more and more evident. I mean, these talks have taken place previously. Yet we still have a war raging on in the Middle East as well as between Russia and Ukraine. So I'd really, really like to see those things come to an end. I think that will be very supportive for global equity markets. But yeah, I do think we kind of slide out the rest of the year. There will definitely be some volatility, but I do think we see some decent positive numbers posted by the time we get to the end of the year.
Awesome. Garth asked a question here. Is there a rotation of markets moving out of the US and into the EU and China as indicated by the market improvement in the DAX, FTSE and Hang Seng?
Yeah, there's definitely a rotation of capital, not necessarily to China yet, but more so between the US and Europe. The catalyst for that was some of the spending announcements at the beginning of the year, in particular Germany committing to spend more on infrastructure and defense and things like that. So yes, there has been a bit of a rotation. However, throughout May, it was almost like some of that rotation was starting to unwind and capital was starting to come back into the US based off the earnings results of a lot of those S&P 500 companies. It's just too hard to ignore when you've got these big businesses just doing so exceptionally well. Keeping in mind that Europe is still, from a growth point of view, they're still somewhat struggling. If you remember, if you cast your mind back to last year, and for quite a while prior to last year, they really haven't been anywhere near the quality of US businesses, and the returns have shown that it's really just been this very short interim rotation, and that was driven more by macro factors like Trump and tariff announcements and things like that. But I think as we start to see more stability in the presidential decision making, I do think the ability for capital to return back to the US is quite high. How does one kind of hedge that? You have global managers or global holdings that have the ability to kind of jump between the two or maintain an exposure to both. So that's typically how we playing out that theme. All of your global managers, all of your global exchange traded funds and things like that naturally have an exposure to other developed markets outside of the US. So you should be benefiting from kind of both of those, let's call it developed markets ex-US doing well as the recovery in the US when it does play out. You're getting both sides of the coin, which is important. But yes, to answer Garth's question, there's definitely been somewhat of a rotation of capital out of the US into Europe. It'll be interesting to see if those European companies can deliver the results and the earnings that people now expect them to deliver, right? The pressures on the capitals has moved across. They now need to deliver.
Yeah. Awesome. My final question to you. I'm about to embark on this investor summit with some of the sort of top speakers in the world. what would be one question that you'd like to know in terms of anything around macro, gold, cryptocurrency, property, America, international? Is there anything that's a burning question that you'd like me to ask and that I could try and find out? And if you can't think of one off the top of your head, I'm happy for anyone, you or anyone else, to send me the questions, because I almost want to create a couple of questions.
Yeah, I'll definitely send you something off the top of my head. Nothing right now, but I'm sure in 10 minutes I'll have a few.
Awesome. Well, ping them over to me, and yeah, let's curate a couple of 10 quality questions. I'd love to kind of be able to get the insights that we want from this group. Well, thank you very much, Anthony. And I think I just want to repeat what before you jump, what I showed as you were arriving, and hopefully now everyone can see that you can do it the old school way. You can kind of go the traditional financial advisor way, or you can have these sessions on a monthly basis, and hopefully you can see that your knowledge and your ability to become an experienced investor just changes, dramatically by doing what Anthony just took us through. Does this make sense? Yeah. Cool. Awesome, Anthony. Thanks for your time, man.
Cool. Pleasure. Cheers, guys.
Cool. Okay, so let's pivot into someone's drawing on my screen. Alistair, stop drawing on my screen. How are you doing that? Disable annotation for others. There we are. How do I delete it? How the hell did you draw on my screen?
Sorry, that wasn't on purpose.
That's all good. I'm just trying to figure out how to get it off. Oh no, I've got to get it off. Just 2 seconds. If I stop share and then let me share again. That's a first for me. Someone can actually draw on my screen. Okay, so let's just go back here quickly and just to kind of explain this. So again, the old school way of doing it, you would go to school, university, you would learn some big picture stuff, you would do a whole bunch of courses. Then, you'd have this huge growth curve, then you would get your degree. And it was at this point that kind of people just kind of traditionally didn't really learn too much more. And this was the typical financial journey for most people. Are you with me? And as you got older, you kind of learned a few more things. And, some people became sort of seasoned and, didn't really change and just got worse and worse. And then some people sort of, learned through time and kind of were average. But the only way to do it is to learn on an ongoing basis. Now, why is that important? And just to kind of show you how this all works, what we basically said, and what I heard you try and say earlier, Derek, is the most important thing is for someone to get a result, which is why we try to create the passive income challenge. Wealth Going Global teaches people about how to get access to the right information and the right partners. I remind you that the poll is actually there and it'll be included free for all of you that are part of the mastermind. So it's no additional cost. But if you want to join me live, I'm redoing it again on the 22nd of July. Then you got Asset Class Mastery, where we continue to bring in the partners so you can learn about all the different asset classes. And then you got the Mastermind, which is the ongoing. So this is what I call our aspirational ladder. And then the Wealth Hackers was just the process to help people effectively climb that ladder. So the digital community. So I'm not going to go into the products and explain them all, but I just wanted to explain to you why and how we put those together to help people go through that journey. And then obviously, specifically what we're trying to do now, which is step 8, every single month, is bring in Anthony and have one learning session every month and to be looking at deals every month, because that's where the learning comes in. So I'm not going to go through that. Tonight in the fireside chat, I will go through that in more detail, and I'll also go into mapping out the future state. So demystifying how people can get access to alternative assets, et cetera, et cetera. But what I want to do now is go into part 2. So how do you actually invest for the 100 years? So you've got traditional investing. So again, if I remind you, that's where you had 3 parts to your life. You went to school, and got a degree. You then kind of worked for 40 odd years, and then you retired for 20 years. You pretty much went and you gave your money, a percentage of your money when you were working, and some retirement fund took it over. And then you got long life investing. Now, what you can see is, and again, what Alex was referring to earlier, is what we call the multifaceted approach. So this is where literally the Calio team sit down, the family office team, and they understand what are your individual circumstances. This is where they start. what is your story? What are your individual circumstances? Then they go through your Enneagram profile. Who are you as a person? What type of investor are you? There's 27 different types. Then they help you build a model. And then this is all put together. So it's 3 legs of a table. So our entire Wealth Weekend, by the way, is built on this triangle so that you know all 3 legs of this table. And when you look at the modeling system, I don't know if you've ever looked at this in detail, but when you sit with Anthony and the team and they do what they call the ALM, the asset liability model, you've got the entire plan. But if you look down here, they literally take it through to 99 years, call it 100 years. So it's planning for the 100 years. And this is where, if you go into it, the 5 key shifts that are required for investing. So the first is from growth to resilience. So this is, for me, what I would take away as kind of Warren Buffett's take, where he says, rule number 1, don't lose money. Rule number 2, refer to rule number 1. Most people in the middle class and most professionals are chasing growth. They're chasing capital growth in houses. They're chasing capital growth in the stock market. They're chasing capital growth in Bitcoin. And what becomes important is to build portfolios that are resilient. It's really, really important long-term to build resilient portfolios. Back to Ray Dalio, 21% a year, average of 15 assets that aren't tied together. That's what resilience means. From short-term to long-term thinking. So again, I always find it fascinating when I help people in China invest, and it tends to be the wealthier people are, the longer term they think. The sort of even new age money, the shorter term they think. So it's really important. 1 to 3 years is very short term. Kind of 3 to 7 years is midterm, and 7 years plus is longer term thinking in terms of where you're looking at. From accumulation to sustainable cash flow. So again, this was Scott Picken when I was younger. So I thought, well, all I had to do was buy at least 10 houses and then I'll be free. So I must just go and accumulate assets. And I don't know if Alex is still online, but this is the whole business owner training we're doing, where accumulation is actually not what it's about. It's about building diversified passive income and sustainable cash flow, because it's the cash flow that gives you the freedom. From national to global diversification. So I think hopefully in this mastermind, I don't need to explain that, but that's where you have all your eggs in one basket, in one country, one currency, to globally diversified. And then from DIY, which is again where we all tried to do it ourselves, to actually working with authorities, coaches, masterminds, collaborative investing. So I hope this makes sense, and I specifically can go into as much detail or as little detail as you want, but I kept it light because I think most of you know what this is all about. Then longevity asset classes, so real estate, and the reason being is it provides income and an inflation hedge over time. Infrastructure, it provides long-term utility and a return. So a great example of this would be data centers, which I would desperately still want to try to get into. Private equity gives long horizons and compounding potential. So things like Austin Business Finance, the Manhattan deal, the Air deal in London, they're all private equity opportunities. Healthcare and wellness investments. We've tried to do a few of these over time, but as you got this aging population, particularly of the baby boomers, healthcare and wellness will always be a massive thing in terms of that process. And then finally, technology. So AI, platforms, and automation as long-term themes. Just by the way, type me in the chat box if you don't mind. How many of you watched that that video I put up from Kathy Wood on the long-term trends? How many of you actually watched it? Let me just get it up for you very quickly. Where's it gone? So I'm just working with multiple screens here. So I want to pull it up for you. So Kathy Wood, here it is here. So it's called The Diary of the CEO.
I've read through a decade of your research to figure out.
Diary of the CEO. So this guy's got an amazing podcast, got 10.8 million subscribers. Kathy Wood is one of the best venture capitalists in the world. She's very much into women empowerment, and she's specifically focused in exponential technologies, cryptocurrencies, etc., blockchain. And this came out a couple of days ago. 2 weeks ago, and I actually watched this. It's phenomenal. It's an hour and 40 minutes. I would strongly recommend. I want to see in the chat box here if other people have read it. Okay, so for those that listen to it, is it worth it for others? So I see Lynette said it. I did. It's very good. I did. It was great. So I've got a question for all of you. I literally took what Kathy Wood spoke about, and I asked. I took the transcription, and I then went to ChatGPT, and I said, right, tell me what are the key takeaways? Because what I found fascinating was that she literally, if you go back to my PowerPoint here, she literally said she's investing in Robinhood because it democratizes and its platform access to the stock market. She said she's investing in Coinbase, which is democratization of cryptocurrency. And I sat there thinking, I should be talking to Kathy Wood because she should be investing in us, because we effectively have democratized access to property and alternative assets. She speaks about blockchain. She speaks about all of the AI-driven platforms, etc. And it just made me realize, and I know I'm sounding arrogant here, and I apologize, but how well positioned we are in terms of where we're actually going. And I know Lynette says there we got the ARK Invest ETFs. Yep, no, completely. Paula said absolutely, very inspiring. Mike said yes. Ilda said I watched yes. So just by the way, would you like the summary? If you'd like the summary, just type in the word there, summary. It's the way my brain's operating nowadays. Always like, right, take the information and summary. But you can see there that those are the 5 sort of recommended longevity asset classes. Right, let's go to part 3, the psychology and planning of the 100-year investor, the investor mindset. So we need to move from scarcity to abundance over 100 years. So scarcity is back to the optometrist, and it's the whole process of, I don't want to outlive my money. Like, you want to be healthy and you want to live a long time, but you don't want to outlive your money. And the problem is your money's not making new money. So you eventually get to the point where you're living off your capital, and you literally are going in the wrong direction. Okay, I can see quite a few people on the summary, so I'll share the summary with you. So the whole idea is to move to abundance, which over the 100 years is what we're doing. And it's that graph where we're consistently re-evolving, relearning, investing in assets that are producing you income. If you invest in quality assets, they should be producing you income all the time. And it doesn't matter how old you get in terms of that process. Understand, just by the way, another thing I would put down to abundance, which is a lesson I learned as well, is sometimes people say, well, I can't afford to do something. I can't afford to join the mastermind, or I can't afford to, in my case, recently go on this investor trip. And then you sort of sit there and you think, can you afford not to do it? Like I had my coach, and I sat with my coach, and she was like, Scott, this is an absolute no-brainer. Like, Robert Kiyosaki has literally personally invited you, and you are worrying about the rands and the cents, the dollars and the cents. It makes no logical sense in terms of the process. And if you look at it over a 3-month period, you might say it's hard to get an ROI in 3 months. But if you look at it over a 3-year or a 30-year period, it's an absolute no-brainer. Understanding volatility as normal over long periods. So this is so interesting. And if you haven't looked at this, because these are all things that I'm trying to now make easy for you. So if you go to here, Anthony did an incredible presentation for our Mastermind members, but I actually took it, and I made a document called The Psychology of Money and Investing in Uncertain Times. And he literally took us through graphs around market volatility and the price of admission over time, okay? And then he basically showed us the danger of market timing. So if you had invested since 1980, $10,000, 1979, $10,000, and you'd missed just, literally, if you'd just stayed in the market the entire time, it would be worth $1.7 million. This is the S&P 500. If you'd missed just the best 5 days, you would lose $700,000. If you missed just the best 10 days, you would have less than half of the money. And if you missed the best 30 days, you would have 274. And if you missed just the best 50, it'd be 120. It's unbelievable, the significance. And then the power of staying invested. If you're in for 1 day, it's 53%. So you still, if you're going to casino, you're still up by a little bit. But over 10 years, you've got a 97% chance. And this is what Garth was talking about at the Wealth Weekend. And then finally, that's the graph to just visually look at. And then a real versus a paper loss. And then lastly, the action points for the psychology of money. stick to your plan, diversify across buckets. Remember that Anthony took us through the whole bucket approach, and then stay the course, and then educate yourself on market cycles. Again, I'm hoping you've got access to all of these. If you don't, please reach out to us. Okay, why fear and emotion destroy the 100-year wealth plan? Again, I've hopefully just shown you that in terms of the process, but ultimately it's because people they go through that greed cycle, and they get scared, and they sell when they shouldn't, and they buy when they shouldn't, in terms of that process. Rewiring financial milestones. So are you going to think of retiring by 65 or freedom by 50 and reinvention? So this is a lovely one. I know I'm about to turn 50, and I know there's many people that are in their 50s, 60s, and 70s. And, what about actually looking at freedom from a younger age and just reinvention? Because you're consistently investing, you're building passive income, and you're building different diversified income streams. And then the person that epitomizes this for me is Richard Branson, because my mother always taught me you can't have everything. And I met Richard Branson, and he had everything. He lived on a private island. He played professional tennis in the morning. He ran 700 businesses between tennis and lunch. And then he went kite surfing in the afternoon. He was happily married. He had 2 great kids. He's lived an incredible life. Like, why can't you have it all? Planning for multiple careers. Oh, and by the way, in terms of reinvention, he started in the music business. He's done airplanes. He's done rocket ships into space. He's done Coca-Cola. You name it in terms of reinvention. Planning for multiple careers and income streams. So again, rewiring our brain. Remember, I started off this morning with be, do, have. So this is all about being, and I think you're in the right place already in terms of this process. And just by the way, a big shout out to Cynthia and to Sharon, because if you take what Cynthia just shared this morning with her new business of doing art retreats in Italy and doing evergreen teaching for children in China, that's a classic example of multiple career and multiple income streams. Family planning and legacy over longer timelines. Again, that's why we've brought in Amy to try and help you with this. Like, how do you actually plan not just your own wealth, but your children's wealth, your siblings' wealth, and put it all together, and legacy over time. And again, we always try and do this where we don't go and try and figure it out ourselves. We go find the best person that we can. And again, a massive shout out to Judy for bringing Amy to the table for us in terms of that process. In terms of new wealth planning tools, well, I've shared with you last month the 4D Wealth Blueprint and how that fits together with everything that Clem Santa teaches and everything Anthony's giving us in terms of that process. The bucketing process, bucket investing for timelines. So again, Anthony's taken us through this multiple times. You got the short-term timeline, you got the medium term, so short-term 1 to 3 years, the medium time 3 to 7 years, and then the long-term 7 years plus. If you don't know about the bucketing, then I strongly recommend that you ask for the report that I've done on the bucket process in terms of that. And then lastly, the freedom calculator. How much is enough? So again, Anthony does the ALM, which is available to all of you because you're part of the Mastermind, which is the much more integrated and personalized process. But we've actually created the freedom calculator for everybody so that they can figure out how much is enough. And then the final thing, practical application and action steps. So create your 100-year investment plan. So again, you've all got access to the family office, but ultimately this is the guideline. Estimate your 100-year, your life horizon, align your financial needs by stage, match assets to time buckets, and set passive income milestones in terms of that process. And in conclusion, most of you would have met me on a webinar. That's how you started off. And I want to finish with 2 things. Don't just plan to live long, invest to thrive. And one of the things that I love is something we came up with years ago, which is to live a life unlimited. So one of the reasons that we feel so strongly about what we do is that we're not just helping someone invest for the next year, the next 3 years, the next 5 years, but for the rest of their life and for legacy. And how do we believe you live a life unlimited? Through Diversification 5.0. And maybe for some of you that have been watching the webinars or coming to the challenges, maybe you're starting to see a little bit about how Scott Pickens' brain is wired and how Wealth Migrate works and how it all sort of comes together now over the last 4 different sessions. So that, ladies and gentlemen, is everything from the 100-year life. I hope that it helps. Tonight at the fireside chat, we can have a discussion about it. We can go into it deeper. I'd really like to have everyone's opinion on it. So come and join us 8 p.m. SAST, 7 p.m. UK time in terms of that process. And I'll also go into mapping out the future state and how we see the world and these trends changing. I've tried today to make it at an individual level, but tonight I will go into where the business opportunities lie as well in terms of that process. Alex, I wanted to ask you quickly before I pivot into the admin. You've spent a lot of time studying the 100-year life, and I'd like just your final perspective. You've given some great insights today already, but your final perspective around the 100-year life, and more importantly, some of the practical advice for investors based on what you and I do on a day-to-day basis. You can see I always prep Alex with the questions.
Was I supposed to pay attention to what you were saying? Yeah, sure. That's a big one. I think my biggest takeaway and biggest thing that's coming up to me right now is the new economy. So, I'm reading or listening to a book called Deep Work. And in the book, they talk about how social media and how the invention of technology, i.e. internet. And also when we talk about the internet, we used to have the static internet where we are now with ChatGPT, etc. It's like the third or fourth wave, and how much depth it actually has been taken away from what we do in our day-to-day lives. So when we start talking about these concepts of the 100-year life, and we start talking about investing for the next 50, 60, 70 years, whatever the case might be, I think it comes down to being aware of what you want to achieve and having that mindset. Because with ChatGPT right now and all of these other AI chatbots and YouTube, you can go learn and you can go and do anything that you want. But ultimately, it's about that mindset of a 100-year life and actually planning for it, and it's difficult because I even speak to my friends that are my age, even younger, and also a little bit older, but they're not in these ecosystems. It's a concept that people don't talk about. It's just like a thing that maybe one day in their life they'll think about it, but they don't have that mindset of actually applying the 100-year life philosophy into their day-to-day lives. I mean, to summarize this in a simple story, this morning I went to CrossFit just before 7:00, and on my way there was like a lot of people going to work, and once I was there was a lot of people going from the house to the work with their little lunch boxes and everything, and I just looked at them and I was like, it's something that it sounds arrogant, but I'm privileged in the sense of I do what I love and I just continue doing what I love. I love analyzing tech, etc. But I'm also very conscious of the next 20, 30 years of where I want to be with that mindset. And I think that's the key point of this 100-year life is it makes you think of the future and where you want to be. And then it actually it's about deciding it and actually making it happen from that perspective, in your teachings and your learnings and your investing in your business, in whatever you do. So truly, it's been, what is it now, 4 or 5, whatever years ago, it's fundamentally been a step change for me in the way that I see and perceive reality. So yeah, I mean, I would highly recommend listening to that book, the 100-year life. And actually following up on it a little bit. I mean, it's everywhere, and it's not a very thick book, and it's an easy read. But yeah, that'll be my closing statement.
Awesome. Well, thank you, Alex. And I've tried to certainly bring out some of the most important parts from that 100-year life. And so, as we always do, what did you think of today's session? Let's have some fun. We're going to count down. Think of 1 or 2 words that sum up the session for you. I'm going to count down 3, 2, 1. And then we can literally put it in the chat. So let's have some fun. 3, 2, 1. What did you think of it? I'm really interested. because it's the first time actually I've ever presented on the 100-year life. It was fascinating for me to do the research on it and everything. And actually sitting here made me think, Alex, that some of these graphs are invaluable for some of our other presentations, because there's so much importance actually in what we're doing. So anyway, I hope as always that the Evan says hopeful to get there. Aren't we all, Evan? I think, but it's also back to that be do have, which I think is so important. And as Judy says, designing my best life. So yeah, I think hopefully today is not only just about investing, but also about who we are as people and where do we want to go. And that's why I did the session 2 weeks ago on purpose. If you missed it, I would recommend watching it. So just to wrap up, I'm conscious of everyone's time. So let me wrap up quickly in terms of the just some admin for the month, which I think is important. Please fill in the poll if you haven't filled it in. I'd really appreciate. It's always valuable to get everyone's feedback in terms of that process. So just reminding you that this is where your comfort zone is. Every month we aim to get people out of their comfort zone because this is where the magic comes in. So just in terms of this, accountability partners, again, it's always useful to have accountability partners. Alex can help you with it, or you can meet people in school, or you can come to the Wild Weekend. And Sharon, I just want to say a huge shout out to you if you're still here. Sharon here, let me see, I can't see who's in the room, but who went and supported Cynthia with her first retreat. And she was saying, Sharon, I don't think you were online earlier when Cynthia was talking about it, but she was just saying, oh no, you are here, Sharon. Good, excellent. I'm glad you can hear this. Cynthia was saying how much it meant to her. So well done to you. That's exactly the type of accountability partners and friendships that get built at the Wealth Weekend. In terms of collaboration, I'm going to be talking tonight in the fireside chat, and I'm going to be going into more detail around this 100-year life and what it means. And then come and join us at the Wealth Weekend. If you haven't been to the Wealth Weekend, I strongly recommend that you do. It is a really important principle. For those of you that were at the first Wealth Weekend back in March 2024, it's evolved a long way in terms of, adding a lot of value. So, come and meet new community members, etc. But we are also going to expand it. So we've got an incredible venue in Knysna, and we are with Paul O'Mahony and others going to be inviting other people to be part of it. So it's going to be a really exciting opportunity in Knysna. This might be the last one in South Africa for a little while as well, because next year we want to focus on Europe with Paul O'Mahony. Okay, in terms of the mastermind, you've continued to got the calendar. So again, I'm just going to show people in case you don't know where to go. Repetition is always the mother of skill, but you can literally go here and you can go to calendar, and everything's always in the calendar. I do try and put it in people's individual inboxes, but I can't rely on email deliverability and all that. So, the responsibility always relies on you to make sure that it's, it's in your diary properly. The investor survey, hopefully everyone knows about that. The buyers trips. Look, I didn't get a huge response to the American buyers trip, which I found interesting, which is fine. I don't mind. I'll keep doing what I'm doing. But if people want to come on buyers trips, then maybe if you are interested in buyers trips and you need more planning and we need to plan properly for next year, then let me know. The 6K versus the 12K, I spoke about that earlier. There's significant value that we've put together now in the 12K. And if you want to chat, just fill in the survey or reach out to Alex and he'll happily have a chat with you. Wealth Migrate versus Private Wealth Global. Again, you can invest on Wealth Migrate from $10. Private Wealth Global is a minimum of $50,000. And it's got a 50% fee reduction in terms of that process. And then the resources, again, I've gone through this a couple of times today, but there are resources here that are very useful to you. I kept in every sort of mastermind session I did, I kept telling people about this. So you've got the perfect week planner, like how to set up your perfect week, the 60-day challenge, which is a fantastic way to build habits. You've got the cheat sheets, which basically Anthony took us through today, all the different indices. And if it didn't make sense to you, him and Alex very kindly created a cheat sheet on what it all means. So you can literally now, behave like a sophisticated investor. You got the One Thing book, which is what Cynthia was talking about. And then you got Getting Things Done, which is just a 5-minute video from Stephen Covey about the important things in your life. One other resource, and I'll talk about that later. Invite your friends. So again, if you want to invite your friends, I've literally given you a free link to Wealth Going Global. If you want to use the affiliate links, then please just reach out to Kelly, and we can actually track everything. In terms of Wealth Going Global, I think, we had amazing feedback from Wealth Going Global. And if you want to participate and let people know about it, you can. That's starting in July. And then just WhatsApp. People always ask me, there's the Wealth University group, there's the Wealth Hacker group, and there's the Mastermind group. You don't need to be in all these groups if you don't want to. I tend to post different material in different groups, but I keep stuff for the Mastermind, just about the Mastermind in the Mastermind group. So if you're only going to pick one group, then it's the Mastermind group. And then a bonus, you've got Business Mastery. So again, if you go back here, I know this isn't for everyone, but for all the business owners, I paid $50,000, $15,000 and then $50,000. And this was actually what I partnered with Tony Robbins to bring out to Africa. And I've basically taken the time. It took me an extraordinary amount of time, but to put it all up here. So there's 7 videos from Tony Robbins on mindset. There's 12 videos from Chet Holmes on how to build and double your business. And there's a bonus session from multiple different people, from Stephen Covey to Jay Abraham to Gary Vaynerchuk. You should recognize a bunch of these names. Anyway, it's there for you. It's free as a bonus. And then lastly,
sorry, just quickly while you're on that, I see a few new names that's recently joined us. Can you just go to school again, and just go to the calendar, even just on Private Wealth Global as well? So literally every Wednesday, for those who you've got your profile sorted and your wallet funded and you've invested already, that's not it's not really valuable from that perspective. But for everyone that has recently joined, not on the Wealth Migrate platform, has not done your KYC, not sure what I'm talking about here, literally, if you go to Private Wealth Global and you click on that link, maybe Scott, if you can just click on that link, you can come join me and we talk about all things platform related. So KYC, KYB, know your client, know your business, how to flow, the flow of funds, all of that stuff. And we've made it very, very simple. Every Wednesday from 12 o'clock to 1 o'clock SAST or whatever time zone you're in, I'll be live for that. So, and then obviously Scott's live every Friday from 12 to 1. I just wanted I've been getting a few questions on like where to find that. So I just wanted to, just share.
And again, as a Mastermind member, a lot of people are time poor. You don't have to turn up to these sessions, but we're available live every week to help in terms of that process. So thanks. Good catch, Alex, in terms of, and you can see them in the calendar. They're always here. Everything's always in one place for you. It's really easy. There's the link. And no matter where you are in the world, the time zone will automatically update to your personal time zone. And if you add it to your calendar, it'll put it in your calendar with your time zone, etc. Okay, right. Let's just finish off. You should have the details for Shanika and Alex. I know Shanika has been amazing, so I'm sure everyone has that. I did also. I know Nikita joined us, and I don't know, Alex, if you want to do an introduction. Is Nikita still here? I know. Is she still here? Let's see. Yes, she is. Nikita is someone that I got highly recommended by a good friend of mine, and many of you have actually met her, Susanna Kennedy, and she's got a lot of experience in what we do. And I'm really excited that Nikita is joining the team in terms of the process. So some of you will be talking with Nikita over the time and in the future. But yeah, Nikita, I just wanted to put a face to the name for the community and welcome you. It's wonderful to have you here. I know we lastminute.com'd you, but I think you've seen how I behave with Alex, which is a little bit impromptu. But I just wanted to welcome you and say it's absolutely wonderful to have you here. You're based out of Cape Town. So for those in Cape Town, and I don't know if you want to say anything. I don't want to put you on the spot, but either you or Alex, but I just wanted to put a face to the name and welcome you to the community.
I definitely don't mind being put on the spot. For those of you in Cape Town, I hope you're staying warm and you have rain jackets because it's freezing. And for those of you who are not in Cape Town, well done. But yeah, very nice to meet you, Scott. Thanks so much for having me. Yeah, I think there's something that I posted on the chat, and I think this, I can only really speak for myself, but essentially this is all very new for me in terms of financial literacy, and something that I want to speak to in terms of what Scott is saying is essentially, you don't know what you don't know. And I certainly don't know a hell of a lot, But with mindset and being able to shift that perspective, then you can truly sort of, change the way you look at the very same things that you've been looking at the entire time. So very excited to be here just to learn just as much as you guys, and also just to be a sounding board and a supportive pillar on his team. So yeah, call me a helicopter parent or a cheerleader, but I'm definitely here to make you guys feel good. Yay! So thank you.
Well, thanks very much, Nikita. And I really look forward to the journey. I love your energy. And hopefully you've learned a little bit about the 100-year life today. And I know it's probably very overwhelming, as it is for most people on this call, by the way. But what I've been trying to do is synthesize for everyone how all the different pieces of the Parthenon are put together, the important columns, and obviously the ongoing learning and specifically the mastermind for us is what is so critical in terms of that online learning to help people get that knowledge. So anyway, but it's wonderful to have you on the team. Thank you so much. Cool. Okay, let me just finish off quickly. What screen are you guys seeing? No, you're seeing the wrong screen. Hang on. I'll unpin you as well. Okay, so back to my PowerPoint. There we are. So and then just with Wealth Migrate, as Alex just said, if you haven't done the Passive Income Challenge, I would. If you want to chat to me about actually being a shareholder in the company, let me know. But we're sort of closing out on that anyway. But yeah, if you want the recordings, the white papers, let me know. And then next month, I'm going to do what I've learned from some of the top investors globally. So I'm about to immerse myself for 9 days with some of the best in the world. And I will give you the trainings on everything I learned. I will be sharing it daily updates, daily insights. If you've got questions or you want me to ask questions from specific speakers, please engage with me and participate. Please share it with other investors. Let's really create buzz. Like, I really want to give people access to this. But for mastermind members who are very time poor, most of us are, I will synthesize the best of everything and put it into a 90-minute presentation for you next month. And next month is the 16th of July. And then finally, tonight, around the fireside chat, I will be going into what we've discussed today, the core story, and how do you actually implement it from an investment perspective. And then obviously, if there's any questions. And then lastly, something we've discussed before, there doesn't seem to be a huge amount of appetite, but what we will be doing within the wealth hacker community, and again, whether people at this level want to do it or not, but we're going to organize an online cash flow game. It takes about 4 hours, and you can play the Robert Kiyosaki's cash flow game live online. So yeah, if you want to, just let us know. We'll let you know when that's happening. And again, that's it for now. It's time for the fireside chat tonight. So we'll see you there. I'm now going to pivot back into the accountability, the mindset, and the execution. So anyone who hasn't had their chance to do that, I'll stay on for as long as it takes now. Otherwise, I'll see you at 8 o'clock tonight. And we'll literally go through your monthly check-in. Just by the way, if you can't send a check-in, you can even send a voice note to me. It's mainly around your accountability. I know Shanique is amazing at getting people to follow up. And in conclusion, money won't create success. The freedom to make it will. And the final thing I wanted to share with you, you've all seen it before. Let me just make sure my sound is being shared, is this little video from Nelson Mandela.
I have walked a long walk to freedom. It has been a lonely road, and it is not over yet.
Thanks very much, everyone. The 100-year journey, the 100-year life. For me, freedom is one of the most important parts of it, and it can be lonely, but we're all on a journey together. I'm very grateful to be on this journey with all of you, and I hope you enjoyed the session today. And to those of you who want to stay on and do the accountability, I will stay here now. Otherwise, I'll see the rest of you at the fireside chat tonight. Have a wonderful rest of your day. Cheers, cheers.